This video is designed to teach you about banking and money creation as far as the AP Economics or AP Macroeconomics course goes. We're going to try to keep things pretty simple and pretty straightforward. Um, Banking and the balance sheets, even if you read, like for example, in our textbook, Module 25, can get into a little bit more depth perhaps than you might need in order to succeed in the AP course. So we're going to keep things pretty simple. And obviously I'll add some things in class, but this is meant to be kind of the bare bones basics that you need. You'll see up on the board, I'm starting to jot some very brief and very simple notes down. So you're going to want to put these in your notebook as well. These are terms that we're going to need in order to understand what's happening here. And then I'm going to kind of run through a money creation exercise or an example that hopefully will help to kind of illustrate the point here and kind of give us an idea of what's happening. So you see the two terms I have up there so far, assets and liabilities. It's very simple just to think of assets and liabilities. A couple of things. It depends on the perspective a lot of the times if something's an asset or a liability. I define an asset as something you own and a liability as something you owe. But if you're the bank, something that's an asset to the bank might be a liability to me, and something that's a liability to the bank might be an asset to me. And so what am I talking about here? If I deposit money at the bank, that's a liability for the bank. It's also an asset for the bank, but it's a liability for the bank because they owe that money to me. To me, that's an asset. Next year when you go to college and you get a loan to go to college, as many of you will unfortunately have to do, um, when you get a loan to go to college, that loan for the bank is an asset. It's something they own that makes them money. To you, it's a liability. That's something you owe the bank. So the same thing, a loan to go to college, for example, or a loan to buy a car or a deposit at a bank can be an asset or a liability depending on what perspective that you're coming from. Um, okay, sorry, a little brief interruption there. So anyway, so an asset and a liability, depending on the perspective, um, can be the same thing depending on which way you're viewing it from. Um, okay, so we have assets and liabilities, very simple, something you own, something you owe. Some other terms that you need to be familiar with are reserves, okay, or bank reserves. Um, that's just the money that banks keep, um, money that banks keep in the vault, okay, as vault cash, okay, very simple term, or on deposit at the Fed. So when we talk about reserves in this class, that's really what we're talking about. And, you know, in the United States, we refer to it as the Fed or the Federal Reserve. If it's in Europe, it would be the European Central Bank, Japan, the Bank of Japan. And for the most part, you can think of the Fed and central banks in this course. If they talk to you about a central bank, if they make up a mythical country, they'll use central bank. If they talk about the United States, they'll talk about the Federal Reserve. You're expected to kind of know both, but ultimately the Fed is a central bank. It's our central bank, the United States Central Bank. And for the sake of this course, AP Macroeconomics, you can kind of view them as one and the same. It's not like the central bank going to do something different than the Fed does, even though since 2006, 2007, different central banks around the world have been doing different things. For this intro course, they're pretty much all going to be doing the same thing. Okay, so that's bank reserves. Another thing that we're going to come across that's going to be kind of key is the reserve ratio. Okay, and that's going to come into play quite a bit here. And the reserve ratio is just the amount banks hold, as reserves. Okay, so in other words, um, if you put $1,000 in the bank, the reserve ratio is how much of that $1,000 do they keep in the vault, or do they give it out to the Fed? And the required reserve ratio is the percentage of deposits the banks must keep as reserves. Okay, so the percentage of deposits that banks must keep. And who determines this? This is determined by the Fed or central banks determine how much banks must keep. And that's where the whole term fractional reserve banking system comes from, which is what we have, a fractional reserve banking system, because of deposits, banks literally keep fractions of those reserves. And that helps create money. That essentially creates money in our system. We'll kind of do an illustration to show that in a second. So this is the percentage. So the reserve ratio, or RR, we'll kind of see it from here out, is the amount the banks keep or hold as reserves of all deposits. And that, in a second, we're going to determine, that's going to help us to determine the money multiplier, which will kind of save us some time going forward. It's a concept you definitely need to know. So let's maybe run through a little example. I think that will help us somewhat here. As we get going, you'll see going forward T accounts or balance sheets. And if you did module 25 homework, you saw that in there. Okay, and assets and liabilities. Okay, and we talked about this before. And for the sake of this class, you know, a balance sheet, it does just that. It kind of balances. Now, I know in the homework, you know, it said that banks are supposed to have more assets and liabilities. You know, it's true in the grander sense, but I think just for this course, you can kind of think of this as generally tending to balance, because you're really just going to be concerned with the demand deposits or the assets, or the excess reserves, the required reserves, and the loans that the banks make. So in this little scenario, let's say you live in an old house here in Saratoga and your family decides to remodel, and you rip down a wall. You know, and the house was built a long time ago, and somebody had hid some cash behind the wall. You know, people that intended to live through the Depression because of the bank runs and stuff became a little nervous about banks. You know, like my grandparents, when they passed, people, you know, my father found money like stashed around their house. So it was not that uncommon. And you find this $1,000, and this $1,000 was already in circulation, but it was just sitting in this wall for years. Okay, and you basically take this $1,000 and you decide you're going to have a good time with it. You go buy yourself like a brand new TV. Okay, so you go to Best Buy and you spend $1,000 on this new TV. Well, Best Buy takes that $1,000 at the end of the day in their cash register. They don't want to leave money lying around in the store, like all the thousands of dollars they make during the day. And so they take your $1,000 and they deposit it at the bank, and that becomes a demand deposit. And a demand deposit is just a way of saying it's in a checking account. Okay, so they put it in their account. It's a demand deposit. So it's a $1,000 demand deposit. And Best Buy owns that essentially. Now, for the bank, let's say KeyBank is kind of owned by Best Buy where we live. So let's say KeyBank here, that's now a liability to KeyBank. Okay, that $1,000, if Best Buy shows back up and wants the $1,000, KeyBank has to give them the $1,000. That's kind of how the banking system works. If people showed up often to banks and didn't get their money, people wouldn't trust the banks. If you've been listening to the podcast, the Planet Money podcast that I've kind of asked you to listen to, there was one podcast on the banks in Myanmar, in which people don't trust the banks because sometimes they showed up and they couldn't get them. So therefore, people couldn't get their money, so people tend not to deposit it. That's something in the United States you tend not to even really think about a lot of the time. Like, of course, the bank's going to give you the money. So the bank has a $1,000 demand deposit. That's a liability, but that $1,000 is also an asset to the bank. And in this country, we're going to assume, unless you're told otherwise, the reserve ratio is 10%. So the Fed basically says to KeyBank, you have to keep 10% of all deposits, of all demand deposits, in required reserves. So 100 becomes required reserves. Okay? That means they have 900 in excess reserves. Now, the goal, KeyBank's goal, like most businesses in this country, is to make money. So if they have $900 in excess reserves sitting in the vault, so right now they have $1,000 in the vault, 100 has to be there, 900 doesn't have to be there, but it's here right now. And there's an opportunity cost to that money for the bank. Okay, the opportunity cost is the money they could be making if they loan that money out. And that's the goal of most banks, is to make money and then what they want to do, and this is kind of in a very simplified banking world. Um, banks want to make loans, so they make money. So they're going to look to try to loan out that $900 to someone they believe will pay them back, and they want to get a, you know, they want to. That's the whole point of the banking system. They want to make money on this. So somebody comes in and say Jeff walks in and he walks into KeyBank and says, I need $900 to fix my car. Okay, so now this $900 is no longer excess reserves. It becomes a loan. Okay, so they make a loan of $900 to Jeff. Okay, Jeff pays his mechanic. His mechanic fixes the car for 900 bucks. But the mechanic doesn't want to leave $900 lying around in his shop overnight, I think kind of understandably. So what ends up happening here? The mechanic takes the $900 and he or she deposits the money in their bank. And let's say their bank is Adirondack Trust. So we're going to do assets, liabilities all over again. So this 900 eventually is going to find its way back into the banking system. This time not a KeyBank, at Adirondack Trust. And so this is the mechanic's demand deposit. And now Adirondack Trust, they have a liability. They owe the mechanic $900. If the mechanic puts the money in, $900 in, they could walk out on the street, turn around instantly, walk back in and say, I need my $900, and they'd have to give it to them. Or they might not touch that $900 again for the next 20 years. Okay, in many ways, Adirondack Trust has no way to know, but what they're going to do, and that's where some of the risk comes in. Okay, so this $900 demand deposit, 90 is required reserves. That means they have 810 of excess reserves. And once again, Adirondack Trust doesn't want to sit on this extra cash in our little scenario. Would they ever have excess reserves? Sometimes banks do have excess reserves. If they don't have anyone they're happy loaning to, if they're afraid of a bank run. I showed you the Colbert Neil Ferguson interview in which Colbert kind of was joking around Neil Ferguson saying, right now banks aren't loaning money. Does that mean there is no money by your logic? And Neil Ferguson's like, well, that's sort of true. Well, this is what they're talking about here. If banks aren't willing to loan and that money can't re-enter the system as demand deposits, well, then the fractional reserve banking system doesn't function properly, and the money supply literally is going to contract. And that's sort of what they were joking about, and that's sort of what I'm trying, I guess, to show you here. So you have 900 demand deposits, 810 in excess reserves. Okay, so 810. Okay, this eventually is going to become a loan. Okay, and where Jeff took out his loan to fix the car, it was Valentine's Day, and somebody came in and borrowed $810, and they wanted to buy their significant other a watch, let's say. That's a scenario we did in a different class. Okay, so you have assets and liabilities. So you go into, whatever the jewelry store is, and you buy a nice watch. Okay, that jewelry store doesn't want to keep a lot of money lying around. Okay, it's not safe. Right? They understand that this is part of what the banking system provides. It provides people security. There's a vault there. It's a little more secure. So that 810 is going to get, let's say, I don't know, Kay Jewelers. It's the only jewelers I've ever heard of, I think. Okay, so Kay Jewelers, $810 makes its way into Kay Jewelers, and we'll say that this is Trustco Bank. Okay, that's where they have their deposit. That's where they have their account. That 810. Now Trustco has an interesting operation here. They have $81 in required reserves. They have $729. They're looking to loan out. You can see what's sort of happening here. If you add up the demand deposits, if Best Buy goes on their account, if if the mechanic, so DD Dunkin' Donuts, if the mechanic goes on their Adirondack Trust website, they're going to see they have 900. Best Buy is going to see it as 1,000. And Kay Jewelers is going to see it's got $810. And what you should understand is only 1,000 of this was actually real money that you found in your vault that started this whole process. And so in that same interview I was talking about, the Colbert-Ferguson interview, when Ferguson was talking about most money is invisible and it's in banks, this is what he's talking about. You added up everybody's balance sheets and everybody went online, and the amount of tangible money doesn't exist to back up what it says everybody has in the bank. And because banks only have to keep 10% of reserves um, in the bank at all times, you kind of understand inherently a problem with the fractional reserve banking system, or what can be a problem. If people show up all at the same time to get their money, it's not there. Okay? If Best Buy showed up and wanted their $1,000, well, there's only 100 in required reserves at KeyBank. They gave out 900 in loans. It's not there. And no bank has it all there. Now, the idea is that not everyone shows up at once. Now, a couple times in history, everyone did show up to get their money out, and that's what led to bank runs. Okay, everyone's showing up, they just don't have it. Even healthy banks don't have it. Okay, now you would follow this process. You would keep doing this all the way through. 729 would get loaned out, would get redeposited. 10% of 729 is required reserves. They'd loan out the rest. It would go all the way through. Fortunately, you don't need to do that, because what you're going to use going forward is the money multiplier to kind of figure this stuff out. And the money multiplier is just 1 over the required reserve system. So, if the required reserve ratio is 10%, well, you can think of that as a fraction. It's 1/10. The reserve ratio is really just the MPS for banks. And if you remember, we got the MPS gave us our multipliers before. So the MPS for banks is 1/10. So the money multiplier is going to be 10. If it was 20% or 1/5, the money multiplier is going to be 5. So you're going to use almost the reserve ratio as the MPS for banks. You'll take the reciprocal. If you think about it, 1 over the reserve ratio, if the reserve ratio is 1/10, that's 1 over 0.1. That is, in fact, 10. So it's pretty simple and straightforward. Okay, and next week in class, we'll kind of go over a little more detail about how you're going to use the money multiplier to change the money supply. But that's kind of the general idea of how money is created for this course.